I tested Nick Shawn strategy for months with my real money, and now I'm here to break everything down for you. Did I make money? Did I blow up my account? This is not a clickbait. I highly urge you to watch this video until the end because I'm gonna reveal exactly how well this strategy performed in my first months using it. You'll see the wins, the losses, the adjustments I made, or is it even profitable at all? So, let's dive in. Nick Shawn is a trader who also has his YouTube channel. I've come across his videos around half a year ago, specifically this video, and what I've noticed immediately is how realistic his approach and his thoughts are. You know, there were no like 40 to 1 risk to reward ratio strategy or 98% win rate strategies. Even more, he was making good points on fairly simple and realistic approaches that I loved immediately. But do a man like me take a word of a YouTuber that I discovered 10 minutes ago? Absolutely no. So I thought about the strategy for a while, ran a few paper trades, and decided that it is time to put it through real world testing. So what is the strategy? Let's say that there is a price somewhere in the chart and there is a level. For example, this one. It coincides with previous levels and is respected. What would we do according to the original strategy? We would open a position to the opposite side of what does the price move. So it moves upwards. We're gonna open short when the price reaches the level. And place our take profit somewhere on the previous level. And that would have been taken. What if the price does not go our direction? For example, here. There also is a level, and the price moves downwards, and we are going to open long, placing take profit somewhere over here. But it just doesn't go our direction. So we are going to wait till the next level, then we're gonna open another position. Thus averaging these two. Let's say, so there is a first position, there is second position. Here. And the price between those two will go exactly to the center. Why? Because exactly in the center, this position, for example, I don't know, let's say $100 and this $100. Here it would be, let's say, minus 20, but this position over here would be plus 20, thus making it a zero. So it means averaging the position. You average it, so you get your combined point of entry over here. But the price still does not go in our direction. So we still keep buying in the next level, which is, yeah, here. And we get another long. Now we have how many percent? Okay, let's say we have 15%. So our average position would be at 10 here. And at this moment, if the position is not profitable so far, and if the position shows the weakness, you just close it in zero or in a really little small profit. As you can see, there would be a lot of opportunities actually. It's like 2 days. Yeah, 2 days. So you would have at least 2 days of opportunity to close the position in profit. But if not in profit, then just close it somewhere near zero. But where does this strategy shine? This strategy really starts to shine because when the price breaks the level, he also opens a hedge position. So right over here, we would open a hedge to the position of what does the price move, meaning short. And we would take our take profit right over here on the next level. So the price moved here and we have a loss in our long. But we also have a profit in our short that we have closed and averaged our long. Then when there is another break of a structure, you open another short to another level, and then you also average. And then the price goes somewhere either into profit or in zero. Thus, let's say we close this position in zero, and made 2 profits from the 2 consecutive shorts from here and from here, thus theoretically making it a profitable strategy. Speaking about myself, I modified this strategy just a little bit in the way so that I do not wait for the break of the structure or break of the level to start hedging. Let's say we had our previous level over here and we would open long here, and then there after the break of the level we would open short. I don't do that. When the price comes to this level, I both open long and short at the same time. And then it goes the way it would in the original strategy. So there would be both positions. Here I would close and wait either for a pullback. Like you see, there's a really small level formed over here. Most likely somewhere over here would be opened another short. And averaging the long so that it goes over there. Then here my second short would be closed, and somewhere over here would be opened the third short, also averaging the long, then closing long over here, averaging the short, opening the long over here, closing it there, maybe opening here another one, also averaging the short somewhere over there, also closing it somewhere, and so you can already see the drawback of that strategy is that you are almost always in the positions, and most of the time the entries of these positions are not really that great. But on the other hand, you get yourself a benefit of a couple of percent when opening the position, because you do not wait for the break of the structure. But what if the price just keeps on going in the same direction without ever reversing? Let's take a look at such example. To simulate hedging, I would have 2 graphs open. On the left one, it would be long graph. On the right one, that would be short graph. So let's open up the position. Long, short. For our long, we would have the next level and the previous level for our short. Let's begin, let's begin with long. Okay, it hit it. It means that right over here, I would also average up my short. Then waiting for a little bit of pullback, opening another long. Like here. Okay, it was not hit. Doesn't matter. Okay, the short was hit, and also we have a pullback, meaning we open another short, and now we wait to average the long. Then also I would relocate my take profit to the next level. And take profit for short over here. Okay. The level is over here. Let's open it up again. Also, again, targeting the level. Honestly, I guess at this moment I would be downsizing because too many consecutive positions on the same more or less price. But let's try it like that also. Okay, that was unexpected, honestly. By the way, I do not average again, because I have already averaged my short right over here when we previously had the long. Okay, it was hit. Wait, I'm a little bit lost in the candles. This candle came to 215. Okay, so it's too early. Okay. Level, long, on the previous level. Waiting for the pullback somewhere over here. Then going short. Okay, so the pullback didn't happen. So I guess we go short over here. Take profit. Previous level. Okay. Averaging out. Also relocating. Take profit. Let's wait for the pullback. Okay, I have lost the pullback. Let's open short over here. Ideally, that would be that should have been here, but I click too fast. Ah, I forgot to take profit. Yeah, there. Okay, how many averaging was already in this position? Long, another long. Okay, so we are one short. To closing it too soon into zero. Okay, this candle. Relocating just a little bit. So, does it look like a pullback? I don't know, maybe. But honestly, not really a lot of room, because the level is right there. Still, it was hit. So, another average, and it is the third one. Meaning, right now we would close the position in zero. Or pretty close to it. Okay, the position was closed. Here we wait for this level to be hit. To open long. Here we wait for this level as well to open another short. Okay. And here comes a fun part, because it finally started crashing. So let's do average and also relocate take profit. Here I guess it could be already pullback, so let's begin. Previous level over here. I'm honestly pretty amazed right now because I was not expecting it to take. I was expecting to get into the drawdown, but okay. Okay, this candle we average, relocating, take profit, waiting for the pullback here. Did it happen? I don't know. Here would be like another level, so let's wait over there. Okay, let's go. I guess we should already average over here, yeah? Because it would have taken the position. Yeah, okay. And we have a pullback. So another average in here, and it is again a third average, meaning we have to close the position as soon as possible. Best, of course, in a little bit of profit, but a drawdown, again, not very big drawdown would also be good. I don't know honestly anymore. Let's wait for another bigger pullback, I guess somewhere over here. Okay, so our third average position closed in profit. And I guess here would be a nice time to open another long. Also targeting the next level. Here we wait for the pullback. And sell. Okay, here it would 100% be another average. And somewhere over here we should close. Okay, finally some fun, because it doesn't happen. You see? Okay, let me just check the levels. Okay, right in the level. Another buy, another time we relocate, take profit, and let's wait. So basically, So at this point, I guess the account is done. And it is more of a question, how much can we minimize our loss? But let's trade again till 15 in shorts. Just the simple levels pullbacks. Okay. The same way we were trading longs. Okay, is it 15th? Almost, but... So, and let's say we close position right over here, our long position. Thus losing 75,000. But our previous longs gave us 28,000 of imaginary money units, while also our shorts gave us 200,000. So we just kinda lost a third of the profits we made, but I would look at this from the point that we earned 2/3 of the profit that we would not if we were only trading long or short or mixed. As you can see, there's also almost no risk involved, because for every your position that goes into the drawdown, there's a hedge that goes into profit. And here I wasn't simulating this, but it would be pretty good to open each next hedge for the equal amount of the position that we have in drawdown. So for example, let's say we had here 3k into drawdown, so here I should have opened a 3k position into short. 3k short position, not 1k short position. Here it should have been also like 3k short position, and here as well. And then I guess we would cover more, and then I guess we would cover most part of this 75,000 lost. Anyways, it was the strategy. Now let's go to the juicy part. My real trades and my P&L over the last month trading the strategy. And so as you can see here, there's my actual P&L for February, which if you add it up, adds up to total of $484.84. Why? Because I had a pending unrealized P&L of 3 combined position by the end of the month, and I closed it really early into the March, on the 2nd of March, for a total of 178. But I did a really stupid mistake over there. I'm gonna show you it later. Most of the days are red. It is the commission for open positions. As you can see, most of the time it is less than $1 a day. And here are the days where I actually close the position. Yeah, and if we look, for example, here, that would be almost 20. I mean, closer to 19, let's say. Okay, it would be 19% over a month for my initial capital of $250. As for the trades themselves, now you can see them on the screen. Here are my first trades that I closed. I closed consecutive 2, I guess, trades on the same, yeah. And so now you can see the positions I took. I closed a consecutive 2 longs on BNB while having short all the way up to here, as well as I closed 2 consecutive shorts on Solana after I closed my long. And here's the stupid mistake that I was talking about. It was 2nd of March, and I looked up in my total combined P&L of all positions, it was plus $174. And I was like, yeah, that's nice, and just hit close all of the positions. And I just forgot that I had this long on BNB for minus $40, and I closed it with this one. And BNB after this, like 2 days after, it hit higher price, so that I would have been able to close it in at least 0. I guess that should have been profit, if I remember correctly, the BNB pricing. But okay, just the pretty stupid mistake that costed me $40. Also, another stupid mistake over there, because the actual drawdown on the BNB short. Okay, let's go on the chart. So unfortunately, order history shows only orders within the last 2 weeks, so I won't be able to show it to you with arrows, but as you can see, on my short, there was like a huge drawdown, like 26%. And all of the time I was supposed at least to hold my short. You see, because the level's over there, but I was watching in 1 hour. So I closed it 2 times, and my short drawdown was minus 300 at the peak, meaning that if I were to hold my long up to that point, that would have been plus 300 in long, but my 2 longs combined at the head, they gave me a plus 100 in total, meaning that I could have made at least $200 more, as well as $40 more if I were to wait for the BNB, because it is 2nd of March. I closed it like 6:16, I guess. Let's see it in 1 hour chart. So here is my, 6:16. So could have been better. Could have been better. Anyway, let's talk about the problems of the strategy that I have discovered over the first months of me trading it. The first one being the obvious: if your hedge is the same size that your main position, then you become too heavy too quick, and your position entry points become too bad too quick as well. Because let's say if you, okay, let's go back to trading view. Because if you open, let's say, long and short here, then you average again, meaning that here you have already closed 2 longs, and you have your short somewhere over there. And here you also open another long for hedging for the same amount, long. Meaning that if your standard position size is 1000, that this short would be already 3000. And at this point, this long would also be already 3000. And they have a huge gap between them. So you already have 6000 in the position with a really huge gap between them. And you cannot really keep on averaging. So you lose on the trading opportunities, you lose on the averaging opportunities, and generally you pretty much risk your account because you cannot add up. You have like 25% between the position that are fixed loss. Because here it would be minus 25% for long, and over there it would be minus 25% for short. And you cannot average this position because they are already too heavy. And another one is that oftentimes the price bounces right to like 50%. And if you average up, I cannot spot it on chart like immediately. Maybe here. Yeah, you see? So if you were, let's say, open a position here and then average it over here, then your position would go somewhere over there. And after the initial bounce, the price can just keep on falling down again. With another bounce, also not reaching your position, keep falling again. And so you won't be able to average this position like ever. So to counter this both problems, I decided to myself that first of all, I'm gonna have my position's initial margin lower to 40% of what I used to trade. So I used to trade $1,000 per position with 2x leverage. And right now I'm gonna take 40% of that, which would be $400. But I would be averaging it more aggressively. So for example, let's simulate our long position over here. So you buy it for 1,000. Then when it reaches this level, we're gonna average it. Okay, average. And you see, it's kinda hard because it doesn't really reach the level, and from this moment, and it just can keep falling back without reversing. And here comes the problem, but if we take my new approach and buy not for 1k but for 400, and the price reaches the same level, but this time, because our position is smaller, we average more aggressively with 600. And you can see pretty quickly you can kinda get yourself into a zero sum, because if you look over here at day, there would have been at least 6 hours that you would be in profit. Meaning that from here you would have already closed your short and then closed your long in zero. And the sooner you get out, the safer these positions are and the less risk you actually take. So dear viewers, that was it for today. If you made it till this point in the video, I would really appreciate you hitting that subscribe button. And stay tuned for at least the next months of me trading that strategy. Okay, see you then.